Hey guys, Joe Frank here, market analyst for YouTrading. In today's video, I'm going to be giving you a quick market update, talking about some of the themes and the news and the moves that we've been seeing so far this week. Let's jump straight into the charts. The S&P 500 here, you can see, has mostly been going sideways within the sort of mid 4,100s, still respecting this uptrend from the March lows. I think the technicals are still pointing towards a test, potentially in the near term, of the yearly high around 4,200. Although, there's a building risk of a break below this uptrend, which could open the door to a drop back down towards some of these support trend resistance levels like 4,070, potentially this little high here from late March, around 4,040, potentially the 200-day moving average below 4,000. Risks are rising. But so far, like the earnings season that we've had so far this week, the banks' earnings have pushed back against the idea that a bank crisis is like underway. Um, and the data we've had so far this week has been kind of mixed. Um, if you'll remember at the start of the week, I talked about it in my Monday video, but we had a very strong Empire State Manufacturing Index report. But today we had a very weak Philly Fed Manufacturing Index report. So, I mean, these regional surveys sending a mixed message. So we're going to be watching the national survey data on Friday, flash PMI data, which is expected to show continued stagnation in the US economy, with manufacturing in recession and services moving towards recession, but not yet in recession. Basically, we're still expecting that weakening. Jobless claims also moved to a little bit higher, and I think actually the continued claims, which is the number of people that continue to claim week over week, having claimed like the previous week, actually hit a new high for, I think, was it? Yeah, look, it's 1.865 million, which is the highest since the end of 2021. So labour market continues to show signs of slow weakening, but weakening nonetheless. Now, this data seems to potentially be weighing on stocks a little bit today. You can see the S&P 500 a little bit lower than and the Nasdaq a little bit lower, although you can see here that the Nasdaq's technicals are still looking good, still respecting that short-term uptrend, still holding above the 21-day moving average, still holding above this key support, Fibonacci support. What's that one? The 38.2% retracement from last year's low to the all-time high. We're in an ascending triangle with a rising risk of a potential breakout higher towards the next key area of resistance, which is, it would be the 50% Fibonacci retracement back to the all-time high from last year's low, and potentially this 13,700 resistance as well. So that's happening there. Yields were pushing higher, but now have reversed a bit after today's weak data. Same with the 10-year yield. But broadly, I mean, we're pretty much where things haven't really moved so far this week, which isn't too surprising because in the US, we haven't had too much by way of important data. Like the strong data early in the week, we went a bit higher with yields. Now weak data, we've reversed it, but we're just back to where we were really. Same with the Dixie, really. You can see it's just been going sideways for the last 4 days, but okay, it's been going sideways for the last 4 days, but still very much appears to be in its downtrend that's been in play, well, actually since early March, but in this trend channel anyway, which has 3 tests of the upper band, 3 tests of the lower band. So technically looking quite nice. We continue to find resistance at the 21-day moving average as well. All of this suggests to me that we're heading back to these yearly lows, and probably going to break through it, to be honest. What about gold? Moving higher, still within this upwards trend channel, kind of opposite to how the Dixie's moving. Bitcoin had a bit of a correction earlier in the week, actually slipped below a near-term uptrend. But, crypto, very volatile, but a lot of people thinking that Bitcoin is in a bull market. So if we do fall back to, say, this support resistance area around here, 26,500, or here, which is actually key one going all the way back to here in terms of support term resistance, 25,200, 300, you'd expect people to buy the dip. Why? Why am I talking about Bitcoin going higher, gold going higher, dollar going lower, yields probably heading lower, stocks potentially going higher? Because the US data is turning, And that is probably going to keep alive bets that the Fed might start, or the Fed is going to start cutting interest rates by the end of the year. Obviously, if those bets really start to get wound down, then we could see further downside in crypto, further downside in gold. We could see the Dixie breaking above its recent downtrend. We could see yields pushing a little bit higher, but I just don't see that as particularly likely. Um, what else? Oil's been reversing lower. Remember, was saying that I thought it would be tough to get above this key resistance area, 200-day moving average, support term resistance going all the way back to last October. And for now, that appears to be true. We're finding support at this little cloud of moving averages here in the 86, 76, 77 area. But yeah, as much as OPEC and OPEC Plus, which includes Russia, can try to do these voluntary output cuts to support the oil price, the economic outlook is souring, and that's bad for the demand outlook, which seems to be weighing on prices. Like, yeah, all the people that were talking about oil going back to 100, not really looking like it right now. But yeah, in terms of what else we're looking out for this week, I talked about the US flash PMIs on Friday, but we've also got flash PMIs out of the Eurozone and UK. And we've also got some other important G10 data like retail sales data out of Canada, retail sales data out of the UK. And there's actually been quite a lot of data out of the UK and Canada this week. Like, for example, yesterday we had a hot UK CPI report, which actually did trigger a bit of macro jitters at the time. Look at this though, CPI out of New Zealand, soft quarter over quarter, or softer than expected, although 1.2% in one quarter is still pretty high. Mixed Canadian inflation data on Tuesday, kind of mixed UK jobs data on Tuesday, but the average hourly or the earnings growth metric, basically average earnings index 3 month, the year over year rate of growth in the last 3 months was hotter than expected. So actually the UK data this week's been quite inflationary, which means that, Bank of England's got to be odds on to keep tightening, basically. But yeah, that's pretty much all the G10 data that we've had this week. What we've got coming up for the rest of the week, keep an eye on Fed speak. Fed members still pushing back against the idea of rate cuts, but they are warning about how, remember the bank crisis in early March, where a couple of banks went under, about how that could be having a chilling effect on the US banking industry, which is lowering lending, which could be hurting economic growth in the US. So they are warning about all these risks. But they're just yet to change their tune on rate cuts, basically, which they're basically talking about not happening. But yeah, guys, hope you enjoyed the video. Hope you'll find it informative. And I'll see you all in the next one.